I now want the conference over to Mr. Aseem Pant, VP Investor Relations from AU Small Finance Bank. Thank you, and over to you, sir.
Thank you, Lizanne. Good morning, everyone, and welcome to AU Bank's earnings call for the fourth quarter of FY21. We thank you all for taking the time to join this call, and I hope you're all safe and well. On the call today, we have our MD and CEO, Mr. Sanjay Agarwal, our Executive Director, Mr. Uttam Tibrewal, and a few members of our senior management team. I would now like to invite Mr. Gaurav Jain, our Group Head of IR from the MD's office, for the opening remarks.
Thank you, Aseem. Good morning, everyone, and I hope that you're all safe and healthy. Amidst the ongoing challenging environment, we wanted to share our reflections on our performance during FY21. Overall, despite the challenging context, especially in the first half of FY21, our performance has been extremely resilient. We were able to keep our asset quality in check, strengthen our balance sheet, increase granularity of our deposits, and significantly bolster our advanced banking and digital properties. I'll take a few minutes to share some color around these points. When the pandemic hit last year, we took a number of steps to address the challenges that arose. First thing we decided to do was caring for our employees' well-being. We started initiatives like COVID-related insurance and ensured no layoffs were made, and made the usual disbursements and around increments and bonuses as we had previously planned. We also ensured that we were there for our customers and maintained constant touch with them through the pandemic. On the financial front, we maintained excess liquidity with average LCR in first half of FY21 at around 150% versus the regulatory minimum requirement of 80%. We took accelerated provisions and further strengthened our balance sheet by raising capital and selling our stake. Despite the challenging circumstances, our performance was very resilient. We increased our customer base to over 20 lakh customers. We increased our deposits by 38% and improved CASA ratio from 14% to 23%. Our cost of funds reduced by 86 bps, which allowed us to maintain stable spread. We increased our AUM by 22% despite muted disbursements in the first half. We delivered a very resilient ROE of 12%, excluding the one-off gains from the sale of our stake, and 23.4% including profits from our. Despite taking accelerated provisions of rupees 380 crores. Overall, our performance has significantly increased our confidence in our customer segments, asset class, and credit underwriting. Further, we continue to invest in building our franchise. Our people strength increased to 22,500 employees, and we expanded our branch presence and opened 37 new branches. We now have 744 touch points in 15 states and 2 union territories. I'm also pleased with the progress we made towards becoming a tech-led bank. We launched our super app in Q3 and are working on adding new products and service journeys. We also launched video banking and UPI QR and continue to increase our internal digitization. Coming to the topic which probably would be of most interest, asset quality, our gross NPA went up to 1,500 crores, which is 4.3% of gross advances, up from 3.7% in Q3 on a pro forma basis. The increase was driven by 1.5% pool of customers who are less than 90 DPD and paying, but were once NPA and have been now tagged as NPA. We expect majority of this pool to regularize over time. 90 plus DPD NPA have reduced from 3.3% to 2.7% quarter on quarter. It is important to note that our collection efforts have been lower than usual due to stay on NPA classification and also our approach towards genuinely impacted borrowers. Overall, given the segment we operate in, which is reflected in our yield, and the lower collection efforts, we strongly feel that we have done well in this challenging environment. Situation on the ground is evolving with the second wave of infections. Our on-the-ground feedback suggests that the situation in core markets is relatively more stable compared to the urban markets from a healthcare point of view. We are hopeful that with the ongoing vaccination drive and actions taken by the government, the situation will stabilize in the near future. In the interim, we will maintain a cautious stance on disbursement, but continue investing to build our franchise and technology. In light of the evolving situation around COVID-19 and the uncertainty it creates, the Board of Directors of the bank has considered it prudent to not propose any dividend for the year ended 31st March 2021. Our recent capital raise strengthens our position to take advantage of the opportunities that lie ahead of us. We feel truly humbled to be able to serve the nation as an essential service provider in these trying times. With this, we can now move on to Q&A.
Thank you. Ladies and gentlemen, we will now begin with the question and answer session. Anyone wishing to ask a question may please press star and 1 on your touchtone telephone. If you wish to remove yourself from the question queue, you may press star and 2. Participants are requested to use handsets while asking a question. Ladies and gentlemen, we will wait for a moment while the question queue assembles. The first question is from the line of Bhavik Dave from Nippon India Mutual Fund. Please go ahead.
Yeah, hi. Good morning, sir. Sir, just wanted to understand your views on incremental asset quality, in the sense we had 1,000 crore kind of NPL and 500 crore that got added during the quarter. Wanted to understand, I understand that we've given some details on the 541 crores additional that we have had to recognize an NPS because of daily stamping. But what is your, and we've still provided 30% on this as well. So wanted to understand how is this different, how is this pool different that we need to provide 30% on this as well, and if they are starting to repay, or some of them have already repaid, and secondly, going forward with the COVID wave in continuation with what is happening currently, how do we think about our customer segment and asset quality for the year FY22 as a whole? So just what your best judgment would help on the asset quality front. That's my first question.
Yeah, hi, Bhavin. Good morning to all. I hope everybody is very safe and healthy. Very tough times, but we'll all have to navigate it together. So, Bhavin, as we commented last call in January, that we are seeing very strong recovery, and that actually continues for the whole of the quarter. And we actually have an average collection efficiency of last quarter is north of 100%, and especially in March, we actually done 112%, which is one of the best of the class in terms of efficiency over the tenure of the financials, right? And so I personally believe, barring the Supreme Court decision, which came so late, the entire market was very positive till March. Customers were able to build their business again. They were able to build their sustainability and were paying back. And if you really see the data very carefully, then you find that our performer NPA, which was actually a 90-day DPD as on December, has gone to a better number now, because that has got reduced. So in that comparison, we have done fairly well. But of course, we also have to over the Supreme Court order, and then we have to classify all NPA from day one. So that has increased our gross NPA by close to 400-500 crores. And but in my opinion, those customers are well enough, because they have paid us some of the amount in last 7 months after the moratorium. And if you really see the whole details there, how much is the 60 DPD, how much is the 30 DPD, you will find a lot of comfort there. And in overall also, in our 1,500 crore GNPL, we have close to 65,000 customers. So that makes us average ticket of 2 lakh rupees, and that's to secure, And you will also appreciate that till March, we were not having any very legalized way to recovery of money, because you were not able to find any kind of legal structure, or you're not able to push a lot of recovery means in that quarter. But after that quarter, of course, we were allowed, but now suddenly this COVID has come back. So it will take some more time to really have a very hardcore recovery on those accounts. But I'm pretty sure that with that time, those customers will be able to sustain themselves and will pay us back, In terms of future guidance, again, it's very difficult as the evolving issues. COVID in last 2 weeks has given us again, in terms of the continuity has damaged that thing. People confidence has gone down, our own team, the external customers. But April actually has not that too bad in terms of collection efficiency. But very difficult to comment for this quarter honestly, because I think we need to settle down COVID first, and then I think everything about business.
Sir, in this 500 odd crores, will we be able to there's a pie chart which talks about 62% of the customers in the 60 to 90 DPD, so that might be a little high risk, but the remaining 38% odd customers, do you think that can be pulled back in maybe the next couple of quarters, or do you think that that will also take some more time for this 500 odd crores number to also come off materially at this point in time?
Well, a very detailed question. I believe we have given our commentary on there. It's a evolving issue. We need to have a little patience there. But I can only say this, that this customer has paid us substantially well from September to March, in those testing times. Average ticket size is very low, it's secure, and of course the breakup is also very supportive that 13% customer on current, 1 to 30 DPD is 9%. So overall it looks okay, but COVID too, has to stabilize first to really have a larger comment on that. And you will also appreciate that, if you take out this 500 crores and the money risk, which we as an executive think is around 1,500 crores, we have a provision of 1,000 crores. So the idea was to really strengthen the balance sheet and not make much of provision so that even when any eventuality comes, it does not hit our balance sheet.
Sure. And so my last question is on the business front, where we have increased our presence from 11 odd states to now 15 states and 2 union territories. So we've added almost 6 new geographies. And obviously we just put one branch each. But what is your thought process here, in the sense that in a COVID year we've expanded our presence in newer geographies? How are we thinking about it? What is your thought process here, and what is the plan here on the newer geographies here? Thank you.
So distribution, we are evolving as a bank, and so distribution will take its own form and shape in times to come. We have done a little bit of expansion in quarter 3, quarter 4, because things was actually looking not much normal. And I don't think that COVID too will have a very long-term, tenure. I can't comment it, but that's my personal thought process. So beyond that, again we will see our distribution plan, and we really want to expand as and when required and as and when things become normal.
Sure, sir. Thank you so much. Thank you. All the best.
Thank you. The next question is from the line of Bharat Shah from ASK Investment Managers Limited. Please go ahead.
Hi Sanjay. I think you are on a speakerphone, so your voice is not coming very clearly, so I'll appreciate it.
Give me 2 minutes, I joined from the other call, just give me 1 minute. We are in a separate room, so don't go to different room. Give me 1 second.
Yeah.
Hi, Bharat bhai.
Yeah, hi. That is better.
Am I audible now?
Yeah. It is better. So my first question, again on the asset quality. If you
You are not
sorry to interrupt. Mr. Bharat Shah, we're not able to hear you.
is my voice clear now?
Sir, you're sounding very soft.
Is the voice clear now?
Better. Thank you.
Yes, sir.
So, Sanjay, I was saying in the first 3 quarters, our provision coverage has been about 2/3. In this quarter, it has come down to roughly half. Now, for non-banking finance company, there is explicit credit cost recognition based on actual experience. So that gives a lot of clarity that what is the credit cost reflected and what is likely to be there, assuming the judgment is made right. Banks still have more roving kind of provisions. So we have to rely on, actual assessment and judgment of the bank concerned. So do you think these increase in the GNPA, but provision coverage coming down to half rather than normal 2/3, you feel confident that this coverage is adequate? And as it stands today, you have no reason to believe that there are any additional costs on the asset book than what have you provided till now?
Bharat bhai, good question, So, and you will appreciate that this is one of the most unprecedented time. We as executive only have to guess and build your experience around creating any kind of provisions. So historically, if you really see that 1/3 kind of money can be lost in the GNPA number, right? And we have done close to 50%. And in that 50%, you will also appreciate that the 90 days and above is only 1,000 crores. So for me, actually, if I do my own calculation on the balance sheet side, then we believe that we are actually covering around 80 to 90%. And as I already commented, that my average ticket on a 90 days book is around 2 lakh rupees, which is secured either by vehicle or by real estate. So I think it's a temporary phenomena where we have a slippages, but with the time it will come back. Now the COVID too has just come, right? And honestly, April has not been that bad in terms of collection efficiency. It has gone 5% or maybe 7%. Today is a closing day, but it is around 5-7% dip from the last April. I mean, not last April, because last April was not normal one, but on a normal April month is a 5% down. So I would believe that as of now, I strongly believe that we are fully covered.
Right. So essentially, you think that as it tends to be, what we have provided and what we have already recognized in the book is adequate.
Mr. Shah, we are not able to hear you clearly.
Okay, my apologies. Is voice clear now?
Yes, much better. Thank you.
Okay, sorry, my apologies. As it stands today, you have every reason to believe that what we have recognized and what we have provided is adequate, and from where it stands, it is unlikely that there is a rude shock on that number.
Yes.
Okay.
Yes.
Thank you. My second question, Sanjay, is on OPEX. While you've been very clear from the beginning that our business plans, growth, investments into building the business and technology will continue, and therefore expenses would be at a little elevated level for a while before the operating leverage kicks in. So I suppose the higher cost in the fourth quarter that we are seeing on a relative basis is merely extension of that, and there is nothing unusual other than that.
So, that's true. We need to keep on investing in our franchise, and technology remains our key focus area. And technology does not come easy, and it's an expensive medium, right? In the initial years, you need to invest on people, the people, the tech, and everything, right? So there the bank would continue to invest, and I strongly believe for next 10 years, if AU has to become one of the most prominent banks in this country, then our digital journeys and tech-led full initiative has to be top-notch, So we are really committed at that side. So that expenses are there. We have launched credit card, we have launched video banking. So that little bit of cost has come from those initiatives also. But one of the items which was ESOP, which has been debited last quarter, is also one of the reasons where you have little bit of elevated cost. Other than that, everything has been very normal one.
Last thing on that ESOP cost, I saw 59 crore debited in this quarter. I just wanted a factual detail. What was the total ESOP cost charge in fiscal 20 and total ESOP cost charge in fiscal 21 in entirety?
Well, can we give this offline? Because it will be required for details. So I will ask my CFO to be in touch with you, and then they will provide you.
Okay, perfect. Thank you so much, Sanjay, and all the very best.
Thank you.
Thank you. The next question is on the line of Rakesh Jujjuwalla from ICICI Securities. Please go ahead.
Yeah, hi, and congrats, sir, on a great set of numbers in this really difficult time. So, sir, just a couple of questions. One is on again on this, less than 90 days liquidity pool. So, just trying to understand over here, why we have sort of take the recognition. As in this slide, we are mentioning that this pool is sort of not in pain as we stand today. I mean, in terms of the March numbers. Almost 13% of the book is current and almost 80% of the book is paying. So what is the rationale behind, accelerating NPA recognition in Q4 rather than waiting for these loan accounts to recover?
No. So by virtue of Supreme Court order, we were not supposed to tag any account as NPA till 23rd of March. So December, when we announced our result, it was a 90 DPD as of 31st December, which we classified as gross pro forma NPLs. So that we got reduced by March. But because 23rd March, when Supreme Court asked to tag NPA, as per the regulation, we need to tag it from 1st of September. So whole NPA tagging came in the last week of March. That is why we recognized all those NPLs. Many of the accounts which were not actually 90 plus, but they were tagged as NPL because once surpasses 90 days, has to be tagged as NPLs.
Got it. So you are saying maybe after September they could have paid something and then would have fallen to NPA, and again they might have started paying in March, and hence we have to recognize.
Yes.
Got it. And so, sir, secondly, on the credit cost side, of course, FY20, we have utilized the Aavas gain on building the buffer. And now we are carrying around 1 billion of provisioning buffer to take care of, any adverse impact of the second wave. But, I mean, based on the current status of our book, I mean, do you feel this 1 billion would be enough to sort of take care of any adverse impact, or you feel, as and when we go ahead, we'll assess the impact and maybe we take a call in Q1 to build further buffer or not?
No. So what happened, if you really carefully see us last full 1 year, we actually have made our balance sheet more stronger. Our net worth has gone up by 43%. in spite of 750 crore or crore kind of provision in last year itself, right? So, and we really want to concentrate more on strengthening our balance sheet, and and who can actually predict how COVID-2 would be,
Correct.
So in the precaution we have built a small contingency provision, so that in case in future we want to build more and more, it should help us, So it's a start point to create a buffer, and as things evolve, we'll create more buffer. But we have that margin, because our yields are around 14.5-15%. So we have enough yield available us to cover this kind of risk, So, and we have actually grown our balance sheet stronger and stronger in last 1 year.
Got it. And so just last question from my side, and this is more on the competition side and market share gain side. So we have seen a pretty sharp, disbursement growth in second half. And we are still, sort of hearing most of the our peer set, the closest competitors like NBFCs on the vehicle finance segment are still struggling with either lower collection or maybe they are still cautious in growing balance sheet. So, what is the scenario? The sharp disbursement is reflection of our, sheer capability to gain market share at accelerated pace, and we are ready to sort of expand balance sheet even in FY22, assuming the second wave is going to stay for, let's say, for next couple of months, or we will sort of, pause and wait and see.
So, that's the way AU operates, honestly, because our wheel and SBL and housing franchise is very old, very seasoned. They know how to operate in this difficult period. And last year they demonstrated that, in spite of Q1, Q2 so bad, Q3, Q4 we came back so strongly, right? So that's the whole distribution and the franchise which we want to operate. And hopefully, I would say it's so difficult to comment for this year. So I would only say that we should have any patience around how COVID-2 actually evolves and how the normalcy comes, and then we will take the appropriate actions.
Okay, but sir, any comment on the market share gain?
So we are too small, honestly. We are too small to talk about market share and all those things. Our wheel book is around close to 2 billion. Our SBL book is close to around 2 billion. Our housing book is close to 2,000 crores. So it's a long way to go. So I think I can only assure my shareholder on this call that your bank is very good in shape. It is in very good in terms of positioning themselves. We are evolving as a very stronger franchise. The team has shown their commitment and character. And I believe, in this time, if team holds themselves and the whole negativity is not there actually. So again, when good times will come, we'll be there.
Got it, sir. I think that reflects in our, best-in-class ROA for the full year. Yeah. Thank you, sir. Thank you so much.
Yeah.
Thank you. The next question is from the line of Amit Nanavati from Nomura. Please go ahead.
Yeah, hi. I just wanted to check, basically we've done pretty well in the last 2 quarters in terms of disbursement, pushing the pedal really hard once we saw the growth opportunity. But if you look at last 2 quarters disbursement, that's basically now 1/3 of our AUM, which is basically relatively much lower vintage book. And if you look at even the COVID environment, last 1 year disbursements is half of our AUMs. I just wanted to see if you can provide any qualitative comments on the behavior of that book versus the relatively more vintage book. That's point one. And secondly, does that kind of change your growth trajectory to some extent, where you'd want to see how the book pans out before you kind of continue to accelerate on the growth front? Yeah, that's it from my side.
Yeah, Amit. So, good question. So I would say because once we started disbursement back in Q3 and Q4, So there was stringent credit policy were applied, and we were also taking a lot of caution in around our underwriting. Customer was also very caution around taking a loan also. So I would say it was more an informed call. So and it was not a good times, right? So there's an old saying that bad books are created in a good times. But I would say it is not that good time, and we created a book. So I strongly believe that book should have better outcome in times to come. And once things become normal, because this vaccination drive becomes very effective, a lot of medication comes and becomes a lot more effective, I think normalcy will be there, and then we'll take the call how we want to underwrite and how we want to book, really want to build book. So as of now, I'm worried about that the book which we wrote last year, can be an issue around us.
Yes, so the reason, sir, I'm asking this is basically with the whole wave 2 hitting, one comes to realization that probably, there's a good chance that COVID will, stay for a longer time. We'll have probably a shorter wave 3. The intensity will keep on decreasing, the impact will keep on decreasing, but at least you will have a more frequent patchy disruptions ahead as well, right? So to that extent, does the growth strategy takes a backseat for now or no?
Yeah, so we are not thinking about growth strategy honestly, because what we done in quarter 3 and quarter 4 was because how the market behaved, right? So again, the call will be very informed basis, how the market is shaping, how and why customers are really looking for the credits, so that call will take as we, will approach that period. Otherwise, I would say, if you really see that quarter 3, quarter 4 when in underwriting, people were more prepared, because this time people are more prepared for COVID. Last year when we had a lockdown, we never had we were not having any preparation around it, right? Right. So the way the whole book performed, you will appreciate that our 80% book is current, and so 80% book is current in March is a very high point for us, So I would believe that once normalcy will come in, people will again able to sustain and will start meeting us.
Understood. Lastly, the taxi aggregator segment and linked segment which got impacted in wave 1, is it largely sitting now in NPAs, or there is something which is sitting in 60 to 90 DPD as well?
So taxi segment has impacted more. So that's why their NPAs will be more. But specific data we can share with you offline.
Sure. That's it from my side. Thank you.
Thank you. We'll move on to the next question. That is from the line of Nadesh Jain from Investec. Please go ahead.
Thanks for the opportunity, sir. So again, on asset quality, I believe overall performance is good. But sir, your commentary at the end of Q3 results where we said that there will not be any requirement of incremental provisions. We have already reached peak of NPA. You also highlighted that the overall challenging pool is around 1,500 crores. So Q on Q, we have not seen any improvement in underlying asset quality, despite Q4 being a very, very strong quarter from an economic standpoint. And probably in these numbers, we have not seen any impact of second wave as of now. So what is the reason for this outcome on the asset quality side?
No, I think I explained very detailed in last 4 or 5 questions. So again, I repeat that if you really see our asset quality, you can't see only one bucket. You need to see the whole my bucket right from current, which is 80%, which is as good as last February, March. Then if you see my one EMI bucket, or which is again around 9%. So I believe if these numbers are there, we should strongly believe that customers are generally has come back, and that was our overall commentary. And if you see the collection efficiency, which is actually remained around north of 100% for whole quarter, right? So that was also very good. And of course, the whole 90 DPD, which generally at this segment, as an NBFC, whole NBFC, we always track 90 DPD, it actually got reduced, And for some of, Supreme Court order which came in last week of March, we actually really missed that, honestly. So that has made us that, around 400 tagged on that particular quarter, right, particular week. So I don't think that because of that one action, we can believe that the correction efficiency or the book has not saved us well, right? So in my opinion, I'm very happy the way our markets are, the way the yields are, and the way we have operated in the ground, it's a fantastic outcome.
Sure, sir, sure. And secondly, sir, can you comment on the credit card product that we are going to launch this financial year? How that will have an impact on our P&L? What sort of investment we are ready to make in that center? Because I think in the initial few years it could be a drag on P&L, and probably after a couple of years it may start to contribute to bottom line. So if you can give some comment.
It's on project basis. As of now, it's on project stage. We would love to comment more on this in our next call.
Okay, sir. Thank you, sir. That's it from my side.
Okay.
Thank you. The next question is from the line of Hiral Desai from Anived Portfolio Managers Private Limited. Please go ahead.
Hello. Hi, Sanjay. Good morning.
Yeah, hi. Good morning.
One more question on asset quality. We've obviously harped on it enough, but you'd spoken last time on the stress segments, so school, taxi, bus, apparel retailer. So just wanted to understand if all of that is now, within the stress pool of either the GNPA or the restructured book.
So I would say we should not color every customer with a sector approach, because even a taxi owner who is more stable, who has more better contract is paying us, and maybe some customer is over leveraged or has some issues, is not paying us. So I don't want to color that every retailer or every taxi owner has become bad, right?
Right.
Maybe little bit more, right? And that, has to be under 4%, correct? So yes. I would appreciate that if my shareholder understand this, the kind of yield we deal in, the kind of market we deal in, if you compare that number with any of our peers, you will find AU numbers far, far better than that.
Okay. And the other thing is, given that this pandemic has been sort of, like once in a century, what are the changes that we've made to the underwriting internally? And, sort of going back to what Amit asked, given that there is a lot of uncertainty around, the disbursement growth has been fairly strong in H2. So, what are the changes that you made to the underwriting to remain confident that, we don't have any asset quality accidents in next 18 to 24 months?
So I would say that, actually, to be very honest with all you people, that I got more strength that, that the kind of underwriting we are doing from years actually passed the test of this pandemic, If you really see my 90 plus is 2.7 on an average yield of 14.5, with a security of wheel or real estate, what should I expect more, to be very honest, So we are not in microfinance, we are not in gold finance, we are actually in an asset which actually brings business for the customers, right? So I think not much of changes we have done in our underwriting. Rather, I have told our team that, what we have done over the years, you have to revalidate your approach around it, So, and, customer has also become very cautious, to be very honest, that nobody wants to borrow money just to default it, and we actually don't give them personal loan. We give them an hardcore security-led loan, So I'm very happy, let the things again settle down, maybe a quarter, 2 quarters. But your bank is on very strong footing in terms of underwriting, in terms of collection, in terms of engagement with the customers, right? That is more important for me.
Sanjay, the other is the geographic mix that you share of the AUM. If I look at that, the growth in Gujarat has been much slower versus rest of the other markets. And it's not a very large book. It's, I think, about 3,500 odd crores. So any specific reason why Gujarat's growth has been a bit slower?
Gujarat is a tough market, not much awareness around customers, around the whole delivery from the financiers, lenders. It's too competitive market. We also don't want to focus much there. We are an old franchise, So we ourselves have taken caution approach around Gujarat market.
Okay. But this is not related to any sort of accidents in terms of asset quality or anything of that sort?
No.
Okay. And the last question that I have is, a lot of these e-commerce offers that you've run through FY21, can you share the kind of money that you spent in terms of the cashback or offers?
So we'll share you offline.
Okay. So lastly, Sanjay, if you can just give me the cost of savings account for the year.
Okay, it's up 6. Cost of savings account, Ishi? Ishi are there?
5.7% is the average cost of the savings account book.
Got it. Thank you and all the best.
Thank you. The next question is from the line of Manish Shukla from Citi. Please go ahead.
Yeah, good morning and thank you for the opportunity. Couple of clarification. If you go to slide 26, you have given the DPD classification for the Onan pool. That maps with the DPD that we have on slide 25, right? I mean, like for like, as of March 21.
So what's the question, Manish? Sorry, can you repeat it?
Slide 25 gives the DPD for the entire book, and slide 26 gives the DPD for the Onan pool. Yeah. I'm assuming that the DPD of slide 26 is a subset of the DPD of slide 25.
Correct.
Yeah, okay. The other question is that, if I understand you right, it is because of the Supreme Court verdict that the additional 440 odd crore has been tagged as NPA. But yet you have chosen to provide as much as 33% on that book, which is in line with your historical LGDs. And I'm assuming that this was not part of your stress consideration as of December. So just trying to understand the provisioning policy on this 440 additional crores which have come through in the March quarter.
Yeah, so we have done little bit of acceleration provision on this book, but on lesser than 90 DPD is generally remain in the as per the policy one. So nothing specific, but you have to classify which book what you have done. But overall, the approach was to remain in a safer zone.
And is it fair to say that this additional 440 odd crore which has been tagged and then less than 90 DPD, most of what would have been their status as of December, as in how much of it would have been current approximately?
So we have given you the Onan pool classification where we say that 13% is current, 9% is 130 DPD.
That's as of 31st March, sir. I'm assuming I'm asking for equivalent number as of 30th December.
Oh, so we'll give you separately.
Okay, thank you. Those are my questions.
Yeah, the amount was very less, 100 crores.
Thank you. The next question is from the line of Abhijit Sakre from Kotak Securities. Please go ahead.
Hi, good morning.
Good morning.
Sir, first question was some color on April performance in terms of, what share of our deals and SBL customers are able to operate during some form of lockdowns and any color on level of collections that we are able to achieve.
So I already commented that business volume has gone down. Our branch footfall is also gone down. Team spirit is also very low because the sudden surge, everybody was caught unaware. And I would say collection efficiency is also down by 5% in comparison to normal April month. Difficult to comment as of now specifically because today is the last day. But my worry would be, how we actually shape up in the month of May. or June I can't comment because the surge has been in the last 2 weeks only.
Got it. And sir, secondly, the initial commentary around some caution for the future outlook. Is the caution more on the growth side, or are you also sort of cautious on how the asset quality outcomes could behave in the next few quarters?
The caution is overall, honestly, because this is very unprecedented, right? COVID-1 actually was more around lockdown because of anxiety around lockdown, but now this is anxiety around health. So we need to really understand that, how the whole situation will evolve. So caution is generally right, and actually, to be very honest, I commented this in the month of March itself that, we really had to be much of caution in the next 4 quarters. So we'll continue to keep eye on this whole development and take the necessary actions.
Sure. And sir, last data question is, what share of our customers would be holding 2 or more products from AU?
So in terms of overlapping around asset is very low, very low. Actually, 10% customer will be overlapping around in assets because we don't fund 2 loans to 1 customer. And in terms of deposit versus asset customer, it's around 20%.
Okay. So sir, that comment on extra NPL because of some customer having a NPL in one of the other products, is that for an other AU product or like across the banking system? Are we referring there?
Sorry, I'm not able to understand the question.
Sir, on that slide with that pie chart, where we are saying that 13% is current, but tagged as an NPL as the customer has other linked.
Current means that he might have 1 account which is 90 plus.
With AU?
Yes, with AU.
Okay.
Yes.
Okay. Sure.
Yeah.
Got it, sir. Got it. Thanks a lot.
Thanks.
Thank you. The next question is from the line of Pranav Gupta from Aditya Birla Sun Life Insurance. Please go ahead.
Hello.
Yeah, hi.
Yeah, hi, sir. Good morning. Sir, just a clarification, and sorry to dwell on the asset quality part again. So I wanted to understand that, this 13% of this 1.5% pool is current, right? So effectively, even if they had been tagged as NPA because of the vacation of the Supreme Court order, had they been current, shouldn't they have been updated in the same quarter immediately? Am I understanding this correctly, or am I missing something?
So we'll answer you offline, because I have answered many questions around asset quality. So if you don't mind, we can connect you separately and answer this one.
Yeah, sure, sir, no problem. The second question is on the cost side. So, despite the pandemic being, part of this, entire year, just wanted to understand, we've added employees quite aggressively throughout the year. Whether this is more on the collection side because of the additional efforts required, or whether it is more on the growth side, can you explain some of that?
Yes, it's an overall building of the franchise. So, like I said, we started credit card, video banking, QR codes. So, team joined there also. We built a little bit more strength to our collection team, overall home loan team. So that's the investment we have done in last 2 quarters. So that's the whole data.
Okay, and just one last question from my end. So, you mentioned that cost of SAR is about 5.7%. And, we've seen a few other SFBs as well, sort of offer higher SAR rates. and even higher TD rates to, garner deposits. Well, I understand that, given the size and given your yields, it makes complete sense to acquire deposits even at this cost. But just wanted to understand, have we, considered cutting deposit rates at all, given the, surplus liquidity which is there in the system? Or, has that not been a consideration set at all for us?
So, Rishi, can you answer this?
Yeah, hi, Rishi here. See, our peak deposit rates over the last 12 months on the TDs, that retail TDs, came from 7.77% to 6.5%, right? And the structure of our savings rate also actually allows that while we offer a peak rate of 7%, the overall blended cost of our SA book is 5.7, right? So we have been very conscious about the rate at which we are raising our deposits, and the other very important thing which we have done over the last 12 months is actually we reduced our dependence on bulk deposits and granularized and retailized our deposit base. That, I think, along with the growth in the SA book, are the more important movements which have happened in the book, and the focus will remain in further granularizing the deposits over the next couple of years.
Sure, sir. That's helpful. Yeah, sure, sir. Thank you so much. That will be all from my end.
Thank you. The next question is on the line of Rahul Maheshwari from Ambit Asset Management. Please go ahead.
Good morning, sir. Hope all well at your end.
Sorry to interrupt, Mr. Maheshwari. We are not able to hear you clearly.
Can you hear me now? Hello?
Slightly better.
Yeah. Good morning, sir. Hope all well at your end. Sir, just two questions, sir, not on asset quality. But, sir, on current, can you give what kind of rejection rate is going on according to you, looking at what the things were better in Jan, and currently how tighten you have done in your credit lending or disbursement pattern? And second thing, sir, on looking at the current stance, and definitely this ONAM, which you told that eventually it will become on a normalized base, but any estimate will how the PCR would be moving on looking at the current situation, whether you want to be more conservative or you would go according how the things are moving on the ground on the collection efficiency side?
Sorry, I'm not able to hear you very clearly, but I believe I have answered all these questions in my previous discussion. But to be again repetitive on that side, I really want to say again that we will take the caution and conservative approach to strengthen our balance sheet, So, and that stance will continue for this year also till the things become normalized, So, and for rest of your question, I believe my team can take offline and explain you.
Sir, but currently, what is the rejection rate in terms of the files which is coming, and what it was in January month? Can you give some color on that, sir?
So that rejection means log into credit, right?
Yeah.
Yeah, so that got login to credit. The rejection ratio actually gone up by 10%. So we were rejecting 10% more than the normal time.
And do you and looking at in April month at the end we are coming, do you expect it will further inch up, sir?
Difficult to comment as of now because suddenly slowdown has been there. So we are watching the situation and we'll see how we'll operate in this scenario.
Okay, sir. I'll get back with the team on PCR, sir.
Yeah.
Thank you.
Thank you. Ladies and gentlemen, we'll be taking the last question. That is on the line of Jeff Loy from Bona Vista Management. Please go ahead. Mr. Jeff Lowy, your line is in the talk mode. Please go ahead. Mr. Jeff Lowy, if you're able to hear us, please go ahead with your question. There seems to be no response from the line of Mr. Jeff Lowy, and that was the last question. I now hand the conference over to Mr. Aseem Pant for his closing comments.
Thanks, Lizanne. I just want to add one clarification to a question that was earlier asked on the 13% current, DPD in the Onan pool. Just to be clear, and we mentioned it in the slide as well, on slide 26, this is tagged as Onan despite being current, mainly because it is linked to a loan which is in the 1 to 90 DPD bucket and not 90 plus. And we mentioned that in the slide as well. And with this, we'll close the call. On behalf of AU Bank, I would like to thank you all once again for joining us, and we hope that you remain safe and well. Please reach out to the investor relations team should you have any further questions or clarifications. Thank you.
Thank you.
Thank you so much.
Ladies and gentlemen, on behalf of AU Small Finance Bank, that concludes this conference call.
Yeah.
Thank you for joining us. And you may now disconnect your lines. Thank you.